Okay, hi everybody. We're back again with Richard Canfield, the expert in infinite banking, and he's here with me, Kyla Lovell, and we're going to just go over some frequently asked questions that people have been asking. So let's start it off right away, Richard, and get right into the juice.
Let's
Okay.
do it.
All right. So, first question. What is guaranteed in the infinite banking policies?
A good question. First thing is, there is no such thing as an infinite banking policy. Infinite banking is a concept. It is something that you do and you implement in your life. There is dividend paying whole life insurance policies, and they are the tool or the mechanism through which individuals like myself and Kyla and you watching have the ability to implement that concept effectively in your life. So it's important to separate the distinction on the question. So there is no such thing as an infinite banking policy. It doesn't exist. No insurance company sells one. What they do sell is dividend paying participating whole life insurance. Okay, so in regards to that, what is guaranteed in dividend paying participating whole life insurance? Well, a number of things. When you get a policy set up, the premium that you begin for the whole life portion, that is guaranteed at the beginning. It's locked in when the policy starts, and it's level and flat through the rest of the life of the policy. The original death benefit is guaranteed. When the insurance company is profitable, they declare what's called a dividend. Once that dividend is declared, so they have a big meeting with all the top dogs and the accountants, and I'm assuming it's like this giant round table, like King Arthur and the Knights of the Round, sort of a thing. And they're all sitting there with goblets and talking about how great they did this year. I don't know if that's what's happening, but something to that effect. And they say, hey, we did a great job. We're going to issue a dividend to our participating owners. They declare that it will be issued, and at that point, it is guaranteed to be paid out to every owner. And then, as the anniversary dates of policies, go along from that point forward, that dividend is then received. So once it's declared, it becomes guaranteed. Once paid, it's paid. It can't be taken away from you. You already received it. Okay. So that becomes guaranteed. And then once that dividend is used to buy paid up insurance, well, you now own that paid up insurance. It's paid up. That means it can't be taken away from you. It now becomes guaranteed. So it isn't there at the beginning, but as dividends are paid and declared, they are guaranteed at that point. What they cannot guarantee is what the future holds. No one on earth can do that. Maybe Nostradamus could. That guy apparently had a little bit of a crystal ball. But a dividend and the profitability on a year-to-year basis for the insurance company, we can make really good, reasonable projections because the insurance company has 100 years plus of history to do that and good data. But the dividend itself is not guaranteed in the future. But once it's been paid, you got it. There you go. And most of the companies that we work with, certainly in North America, there's an amazing track record. In Canada, an exceptional track record where companies have been paying dividends. The oldest company in Canada has been paying dividends every single year since 1848, which is before Canada became a nation under the signing of the British North America Act, which was in 1867.
Great, amazing answer. Thank you so much for that clarity. All right, so I have one answer to the next question, and I'll let you do the rest. But does the infinite banking concept have another name? And I'm going to go with IBC. And can you elaborate on any more?
So the infinite banking concept was pioneered and developed by R. Nelson Nash. So everything about this concept stems from this book, Becoming Your Own Banker. It is, I refer to it as the Bible for this concept. A lot of people don't appreciate the connection of that, but for me, that just is a simple way of looking at it. Nelson is the creator of this concept. And the process of becoming your own banker is something that you do. Okay. Again, it's not a contract or it's not insurance. Insurance is simply a tool that we utilize. The infinite banking concept is exactly that. It's a concept. It's a way of thinking about things. Becoming your own banker is an action. You become the banker. The banker is the one who controls the rules around how we move money throughout our life. Deposits, payments, the loans that we get, the loans we repay, how we do it, the interest rates, all these things is what the banker's role is. You get to become that individual by implementing the concept that Nelson developed. So the names are the infinite banking concept, IBC for short. There's a lot of people who put labels on these things to try to, I guess, market the concept in other ways. or put their own spin on it. I think primarily that's mostly based on just people trying to enhance their own marketing. So there is several other types of, I guess, similar or associated names that people might label it as. I've heard ones like cash flow banking. Some people have used like cash flow hacking. What's some other ones? Some people use the idea of bank on yourself, which was a term coined, and I believe it's been registered intellectual property by Pamela Yellen. Pamela used to have Nelson Nash attend her sessions, and she even honored him. However, she never honored him with dollars to say thank you for developing this concept. So I personally disagree. I don't like that utilization. I also disagree with the idea of bank on yourself, because you can't bank on yourself. You can implement a banking process. You yourself can be the banker, and you can utilize a tool, dividend paying whole life insurance, to implement a process. But that's not yourself. You're not an insurance company. You're not an institution. You are you, right? So you can utilize the framework and the infrastructure of what an institution has built and has all the mechanics to run and operate. And you can utilize the mechanics of your own decision making to play the role of the banker so that you have more control, and then you can implement this process in your life. So, it's not like an easy, quick and dirty answer, Kyla, but the reality is there's a lot of misleading marketing in the marketplace in general. Personally, it irritates me, I'm sorry to say. And I think we're doing our best, and good folks like you helping to really get clear on where this message stemmed from and who's its creator is Nelson Nash. The more people recognize and understand that, the simpler and easier it becomes for everybody who wants to engage in this process in their personal life.
Amazing. Thank you so much for that. I know a lot of people are saying, I've heard of that, but it's called something else. So thank you for the clarification. All right. The next question is, does the insurance company retain my cash value when I pass away? I know this is a big one. Um, and Dave Ramsey has said something about that. So what's your take on that?
It's just it's a very misleading thing. The insurance company doesn't retain anything. Cash value isn't actual money. It's not like everyone who has an insurance contract, the insurance company has like 10, 1 million accounts for every participating owner, and they're building up a little account with its own money in it that's got Bob's name and Jane's name and Sally's name on it. That's not how it operates. Cash value is capital. It's a representation of value. It's a direct representation of a future death benefit. So the cash value and the death benefit are actually the same thing. The problem is one is a present value and one is a future value. And so the reason that, so cash must grow to equal the eventual death benefit. That is one of the guaranteed components of the contract. So the cash is growing and growing and growing to pay the death benefit. That's because the insurance company is on the hook for the whole life of the insured person. They must pay a death benefit. As long as that contract is in good standing and someone has fulfilled their obligation of paying the premium, or the premium has been funded in some way as they're designed, then they must pay the death benefit. Therefore, they have to grow cash value for the purpose of paying that death benefit. So the cash and the death benefit are linked. They're just at two different points in time throughout that journey. So when you utilize cash value as collateral to get a policy loan from the insurance company that you co-own, you're actually, a way to look at this is that you're taking an advance on a future death benefit. It's kind of like you're using your future death benefit as a credit card, to try to keep it simple as an analogy. And so do you get to keep the cash value? Well, the answer is no, you don't keep it, because you get the death benefit, and the death benefit and the cash value are actually the same. So you cannot separate the one from the other. There are other types of insurance policies known as universal life that have a lot of risk. I refer to them as a buy term and invest the difference bundle with a Vegas style slot machine attached to the side of it, where you can theoretically invest money and hopefully you'll beat the market, etc. But the insurance company sheds the guarantees that they provide, let's say in par to some degree, and they offload the risk of those contracts onto the individual. Instead of them taking on the risk, they're saying, you take on the risk. Good luck. Hope you get there. See you later. And so in those scenarios, you actually have a side account, a side fund, which is a representation of cash value. And that is typically invested in a bag of funds of some kind, generally speaking. And so it can go up and it can go down and all these other things. So in that scenario, what you actually have is a level cost of term insurance, essentially, with this side account. So if the side account builds up, well, then what'll happen is you get the term insurance, that amount, or the universal life coverage, which is a representation of basically term 100, essentially, being very simplistic here. And then if you build up a investment value, well, then those two things will pay out. But it's not the same as whole life, because whole life, the death benefit and the cash value are linked. They're a representation of one another. And that is not the case in other types of insurance contracts. So again, bit of a long-winded answer, but to give people a good idea, you do not get the cash value in a whole life contract when you die, because you get the death benefit. So in essence, you do get the cash value, but you're actually getting the death benefit, which is a representation of the cash value. Hope that makes sense.
It does. It does. Thank you so much. And anybody who doesn't understand can rewind that. That was an excellent explanation.
Go back and go through it one more time.
Okay, this one should be a little bit easier. So, and you're doing very well with answering. So, how much cash value can I borrow, and how long does it take to receive the funds?
You can access from most contracts in Canada. They vary to a little bit of degree, but in general, 90%, that's 90%, 90% of the cash value, the total cash value. Total cash value is not the same as surrender value. Okay. Surrender value may include a little bit of excess premium that's been sitting on the sidelines. And if you were to take a policy loan already and you have a loan balance, well, so you have a total cash asset. Now you have a policy loan. Well, surrender value will come down relative to having a loan outstanding, because if you surrendered the contract, please don't do that. If you did surrender a contract, though, the loan must be returned to the insurance company at that point, because it's collateral. Okay. So 90% of the total cash value, which is a combination of the guaranteed cash building up for the original base policy, plus on top of it, paid up cash values, which is created from paid up addition death benefit added to the contract, usually by the way we structure the premium going in, and from the accumulation of dividends buying more paid up additions. So those things work in tandem together to raise up the level of paid up additions, which increases paid up cash, and the guaranteed cash are rising all at the same time. And so it continues rising to meet its eventual obligation of meeting the death benefit. And you can access 90% of those values on any given day. Some insurance carriers may have a limitation where you cannot take a policy loan for the first year. There's one particularly in Canada that I'm aware of that does that. In general, there's not a lot of other limitations, and the timing of receiving the loans may vary by insurance carrier based on their processing timelines, how many people are working for them that day, who's being trained in a new department because maybe they have administrative challenges, let's say, as an insurance carrier. But in general, from the date of a request being received by the life company, typically within about, I would say, 5 to 10 business days, 5 to 7 is a pretty good average. That money could be direct deposited back to the policy owner's bank account. So it can be a very quick turnaround time. One insurance company in Canada, which I personally own most of my policies with, I do a lot of business with, they're an amazing company. I'm very fond of them. They actually have an online access mechanism where you can see your values daily, the loan available, loan outstanding, cash values increasing daily. And you could click a button now. It's a new feature, something that we've been asking for a decade. Really great feature for consumers. That you can click a button to basically request an online loan digitally, sign a digital loan agreement, and boom, that money gets direct deposited in a fairly short time frame.
Yes, awesome. Yeah, I really like that. Click a button. That works. That was great. Great new added feature there. That's awesome.
We've been waiting for that one for a long time. We're getting into the 21st century finally with the insurance companies.
Okay, good. I'm going to ask you one more question on this quick round. Okay. And the last one is, well, it was how can I access my funds? So other than the click a button, what would be the other way to access the money?
So the other way is you would fill out a manual policy loan form. They're typically 1 to 2 pages. Usually 1 page is all that really matters. The other page is a bunch of useless information, but it's a 2-page form. sign it, date it, and you send it in to the life company, or depending on your relationship with your advisor, your coach, communicate with them, especially your first couple policy loans. So you have a good idea what you're doing. Make sure the loan request is filled out correctly. It gets sent in the life company, and then you kind of sit and twiddle your thumbs and wait for the money to land in your account. If it doesn't land in your account within, let's say, within 2 weeks or so, you definitely want to follow up to see if it's gotten missed in the queue in some way. These things do happen from time to time. It's relatively rare, but again, you're the banker. So you're the one that needs to take the responsibility and be proactive to look out for that stuff.
Okay. And is there any other way? I think you've told before, but the phone call.
There is, to some
Option?
degree, with some carriers, one for sure in Canada, I think of, a policy owner can call in, you verify your identity, policy number, etc., a couple of basic questions for verification, and then you could request a policy loan over the phone. And that's they might have a limit on how much you can do. I know with one company, it used to be 25,000. I don't know if they've raised that at all. But there is an option for that. It doesn't necessarily work for every company, but there are a few available where that is an option.
Okay. Amazing. Amazing. So that was great knowledge. Thank you so much for that, Richard. It's very, very appreciated. Okay. And hopefully we can do this again and get some more questions answered. And would you like to say anything else before we leave and head out?
No, these are great questions, and let's keep them going. Let's get some more done on our next visit.
Okay. Thanks for the juice, Richard. Appreciate it. And
All
have
right.
a great day. Bye bye.
Cheers.